Good afternoon, options traders. Well, as promised, I said this week we were going to talk about hedges, and probably for the next coming weeks because of the coronavirus panic. And for anybody who has worked with me knows that that's always a big subject of my positions and of my strategies. It's always about setting up hedges. So what is a hedge and why is it so important? Well, in simplistic terms, a hedge is nothing more than, you can think of it as a protective barrier. And that's actually where the word comes from. It's really from kind of the ancient farmers who used to build a row of shrubs around their property to say, hey, this is mine. It was a protective barrier. So in finance, when we talk about a hedge, that's what you're doing. And we're normally doing it with what's called an offsetting position. Some type of an asset, could be futures contracts, options contracts, could even be shares of stock if they're used in the right way, but it's an offsetting position. And what that means is that the value moves in the opposite direction. And in doing so, it sets up some type of a protective barrier. Now this is, by the way, quite interestingly, where hedge funds get their name, because hedge funds are allowed to kind of go outside the normal range of assets that most of your mutual funds and things like that are not allowed to invest in. And so they are allowed to create more protective barriers. That was the idea. Unfortunately, they take all of these different assets in there and use them in super speculative ways. So they call them hedge funds, but they're far more like speculative funds. But anyway, that's where the word comes from. So here's a very basic idea of a hedge. Here's a profit and loss diagram for a long stock position. And I think everybody knows you can gain and lose dollar for dollar. So what's the big risk? The risk is to the downside, down here. And as I always tell traders, one of the basic principles of financial risk management is to avoid extreme outcomes. And yet that's what you're subjecting yourself to here. You can either make it all or lose it all. So how could we hedge this position? Well, a very simple hedge might be to buy a put option. So let's say if you buy a $50 put, that profit and loss diagram by itself would be like this in green. Now notice what's happening here below your strike. As the stock price falls in this direction, the put option's value is going in this direction. It's moving opposite. And so they tend to cancel out. So that means if we buy the stock and we buy the put, we have them both in our account, then these two graphs blend together to form this. Notice that the left-hand side below the strike down here is flat. And that's because of those offsetting positions. So some of you might recognize this as a profit and loss diagram for a long call. And if you've seen the video on synthetic options, you'll also recognize that a call option is in fact identical to long shares of stock plus a put. So that's kind of an odd thing in itself. A long call is actually insured shares of stock. Different perspective from what most people would tell you. So the bigger question though is, why does it benefit you? I mean, big deal that we alter the risks and rewards. How do you benefit? Well, let me show you a really good example with a football pool. So to keep it simple, let's say that you're in an office with one other person. Yeah, it would work with a bigger office, but to keep the math simple, we're just going to assume that there's two of you. Every week you're going to participate in a football pool. Team A versus Team B, you get to take your picks. We're also going to assume that Team A and B each week are equally likely to win. So what's going to happen in the long run? What can we expect? Well, let's say that the football pool goes around to your coworker first and he says, I want to put $10 on Team A. And you go, well, doesn't leave me much of a choice. Let me put $10 on Team B. Well, if you do this every week, what can you expect to happen? On average, you're going to win half the time, you're going to lose half the time, you're going to end up with nothing. You're going to do a lot of work for nothing. You're also subjecting yourself to extreme outcomes. You're either going to double your money or you're going to lose it all. And as I just said, one of the ideas of financial risk management is to avoid these extreme outcomes. So what's another choice you could do? Well, you might say, I guess I could maybe bet on A as well. That's not much of a bet. If Team A wins, there's 20 bucks in the pot, you split it, you walk away with the same amount that you started with. If Team B wins, I guess we just roll it over into the next week. But there's no real incentive to match your coworker. What else can we do? Well, we could set up a hedge. What if we bet $10 on Team A and we also bet $10 on Team B? Now think about what happens. You've got $20 invested. If Team A wins, then the money flows from the pot over here on Team B into Team A. There's now $30 in there. We split it between the two people. You walk away with 15. But you spent 20, so you're down 5. But now what happens if Team B wins? Well, let's go back to the initial setup. If Team B wins, all of the money from Team A flows over to this side. There's now $30 in the pot, but you get to keep it all. So in these cases, you're going to win 30, you spent 20, on a net basis, you're up 10. So what can you expect to happen in the long run? Well, mathematically, you're going to lose $5 half the time. Remember, both teams are equally likely. And you're going to win $10 half the time. And that means your net expected value is a positive 250. That's a whole lot better than 0 when you're betting against your coworker. And it can only happen once you understand how to hedge your positions. So the main thing to understand, the key insight, is that by using a hedge, we were able to create something that's going to give us a positive expected edge. We can expect to earn $2.50 each and every week, when without a hedge, we would just be spinning our wheels. And that is why it's so critical to learn how to hedge your positions. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.